Focus now to Gibraltar, where a hearing is currently underway at its Supreme Court over whether Iranian tanker Grace 1 should be released or remain under its territorial waters. The visuals on your screens are of Michael Lamas, the Attorney General for Gibraltar, who arrived at the court earlier in the day. Now, Gibraltar was for most part expected to release Grace 1, the tanker, today, but a last-moment bid by the U.S. Justice Department to seize the tanker has halted its release. The governor of Gibraltar says that the U.S. Department of Justice applied to seize the tanker on a number of allegations which are being considered. The decision can be out any time now. Remember, the seized tanker is being seen as a pawn in the standoff between Iran on the west, with its fate tangled in the diplomatic differences between the European Union nations and the United States of America. The tanker was seized last month in a British Royal Navy operation off the coast of Gibraltar on the southern tip of Spain. Meanwhile, there is some worrying news for the global economy with something called as yield curves from both the US and the UK inverting for the first time. Now, the inversion of a yield curve is considered to be a classic signal of recession. Every time yield curves inverted, a recession has followed, the last one being the year 2008. First things first, what exactly is a yield curve? A yield curve measures the expected return on various debt financial instruments like bonds over different periods of time. What you are seeing on your screens now is a normal yield curve. It's an upward sloping one. It's because in a normal scenario, investors expect higher returns from a longer investment. But the yield curves that have just come out look something like this. It's an inverted one. This essentially means that a 30-year bond, for example, is giving you lesser returns than a 5-year one. So why is this happening? Investors are extremely pessimistic about the global growth trajectory. So they are looking for safe places in the market to invest. And as we just mentioned before, long-term bonds are the safer bet due to longer commitment. Let's take a look at the U.S. yield curve. The 10-year yield fell by 8 basis points to 1.62%, while the 2-year yield fell by 3 basis points to 1.63%. This means the gap between the two yields is now below zero. It's a similar situation across the Atlantic in the United Kingdom. The 10-year bond yield fell by 2 basis points, while the 2-year yield rose by 1 basis point to once again make the gap zero, below zero. This is a trend that has been developing for the last couple of years. The yield curve has been gradually flattening on account of the lack of investors' confidence, and the tipping point seems to have been reached. There are multiple reasons for this slowdown. The US-China trade war has plunged manufacturing growth and trade across the world. China recorded its worst industrial growth in 17 years, while Europe remains under the cloud of Brexit. According to experts, a no-deal Brexit is almost certain to push the country into recession. Economic indicators from major European economies like Germany and France have also been discouraging. Just recently, the Federal Reserve in the US, the central bank of the US, pegged the probability of a recession in the next 12 months at 31%, the highest prediction since the 2008 crisis. There's also speculation that the Federal Reserve may act aggressively when it meets next month. So far, market experts have been predicting a 25 basis point rate cut by the US Federal Reserve. But with a clear message that short-term rates are too high, the ball is fairly in the court of central banks, both in the US and across the world.